More downside pressure for gold this Friday. Gary Wagner explains things on the technical front next. Thanks for joining us this Friday, Gary, as we head into the weekend here.
My pleasure. My pleasure as always.
Tough week for gold, Gary. Now, last time we spoke, you were saying how the 1270 level was really key and gold had to hold that level. It's since breached that. And now I guess the question is, what's next for gold? Gary, the fear is, from others I've spoken to, that gold could head down to 1,000.
Well, you know, I don't know about $1,000 level, and I'm not going to comment about that yet. The critical action that we saw was that myself, along with many other analysts, had identified what I call a compression triangle. Many analysts call it a wedge. And really what we were seeing was a scenario in which we had a series of lower highs, higher lows. That range kept narrowing. And the theory behind this type of a pattern is, as it approaches the apex of that triangle, what you'll typically see is a release of energy when it hits the end of that. And so we noticed that over the last month and a half in trading. The one thing about a compression triangle is it doesn't tell you which way the market will move once it breaks. It's simply indicating a potential for a hard break. We got that. The critical number to me is 1262, and that's based upon a 61% retracement from the most recent rally beginning at the beginning of the year, in which we saw the market move from 1181 up to 1391. When you look at a 61% retracement, it hits you at 1262. When the market sold off midweek, that's exactly what we got. However, it's now trading just a tad below it, in the mid 50s. Because of that, my sense is our next real level we need to watch, if it continues under pressure, has absolutely got to be about 1232.
Now, Gary, some analysts I've spoken to have said, look, gold generally tends to act sloppy during the summer months. Do you agree with this, Gary? Historically, do you see a pattern that's repeating?
There are some similarities that we're seeing in terms of seasonal tendencies in gold and gold trading. When we looked historically at how the market had reacted in other years, in the same time period. So for example, last year we saw it really compress and consolidate. It did trade sloppy. It traded in a very tight range, and then it broke to the upside. There is somewhat of a seasonal tendency to get range bound as we go into the summer months, yes.
On that note, Gary, what have you brought us today?
Well, we're going to look at a couple of things. First thing that we want to look at is that compression triangle, how it broke, what led up to these events that we saw within the market, and how they kind of unfolded in terms of the charts. The second thing, and most importantly, is where we think this market could go based upon the actions in trading this week.
Great, Gary. And before we get to that, just one last question as we roll into Friday afternoon here, Gary. What close is key for you for gold?
You know, I would like to see whether it was this week or even early next week, the market to creep back up and find some sort of base at around the 1260, 1262 area. Obviously, on Thursday, it was a little bit below. Trading has really gotten quiet towards the end of the week after that big sell-off that we saw midweek. So that's an important number. If we cannot close above that, as I said, the next real level of support doesn't come in until about 1232.
All right, on that note, let's get to your insert.
Absolutely. On today's insert, I want to take a look at the recent price activity, the dramatic drop we saw at the beginning of the week, and attempt to put it into some type of context. From there, ascertain, most importantly, have we caused some real long-term damage? Is this a game changer, so to speak, and where we think this market could be headed? You know, traders, up until the moment that this market actually broke hard to the downside, the overall characteristic over the last, 6 weeks in trading was that this market was really caught in a narrowly defined range. We're looking at a 6-hour Japanese average chart. And more importantly than this range that kept narrowing, the pattern that created was what I tend to call a compression triangle. It's also called a wedge. And it was identified by myself as well as other analysts in the market. And simply put, what we're looking at in this type of a pattern formation is a series of lower highs and at the same time a series of higher lows. And that's exactly what we got as this market approached the apex of this pattern. So when we take a look at the recent activity, a couple of things really stand out. First of all, when we look at it in terms of a Japanese average chart, what you get is the series of oscillation of color from green to red, green to red. In other words, that's a sideways trading market. Because as you know, especially with the Japanese average chart, which filters out a lot of the noise, you get a succession of consistent colored candles on the way up as well as on the way down. You might get a green here or there in a sell-off or a short, small correction as the market rises, but for the most part, you're getting this consecutive candle color. Now, notice as we got towards the apex, the color change happened even more dramatic from oscillating back and forth. And the whole theory behind this pattern is when it hits the apex, it doesn't necessitate which way you'll see the market break, whether it's down or up. But the idea behind it, simply put, is that there's a major release of energy. So with that in mind, and with that as a context to looking at the market, where do we think this market might go? Well, the first thing that we have to pay a lot of attention to is the Fibonacci retracement that I've put into this chart. Very, very simple fib retracement, very short term in length. And really what it's looking at is this entire rally that we had at the end of last year, beginning of this year, and the fact that we, up until this dramatic break this week, we're always sustaining ourselves above this 61% retracement level. 1262. That's why I have put such primary and critical importance to this particular number. The fact that we're currently trading below this is really a very bearish scenario, because the next real level of short-term support isn't really up until about 1232, and that of course is a 76% retracement. And you can really see the importance of this 61% retracement when we pull up a daily chart as we have just now. You can see, first of all, that we have this series of tops, and we have this area where it's very much a resistance area right before we saw the second part of this dramatic rally, of course, this beginning December of last year. It pops up, we get a small correction, and then a final move to just below $1,300 per ounce. This 61% level is absolutely important on a short-term chart. But the number on a long-term chart that becomes of critical importance right now, I believe, is the number right around 1229 to 1234. Let me put that in here. And the reason that that is so important is when we look at the most historical rise in gold, meaning going back to the market when it was trading at $600 an ounce, plotting it up to above 1900, and then looking at the retracement, and a retracement of 50%, that takes you to 1230 and is just below the current price of gold, give or take 20 plus $25. That's very, very close in terms of a long-term perspective. So in terms of causing major long-term damage on the charts, well, we've already had these two lows come in, and these are the lows at 1181. Our next real level, should the market continue to drop, has got to be 1229, and then of course we still have a 61% retracement. That's well below where this market is currently trading at. You know, this has been a dramatic week, to say the least. And whether or not we've caused long-term damage is definitely something we want to explore, and looking at the long-term potential for the price moves in gold is something we want to explore. And to that end, I am coming out this weekend with a special report. Now, all members of Chart This after the show will be receiving an email when we get that on the air. It's going to come out either Saturday or Sunday. If you're a member, we're going to send you a notification. There's nothing you need to do. If you're not a member of After the Show, simply go to our website, goldforecast.com. When you get there, simply click that link that allows you to sign up for After the Show and go ahead and create your free account. Again, Fibonacci retracement and candlesticks as it pertains to forecasting the future price of gold.
Thank you, Gary.
My pleasure. I want to wish all of our Chartist viewers happy and prosperous trading next week. We'll talk to you real soon. Bye-bye.
Thank you, Gary. And to our New York City viewers, if you're interested in where the PGMs, the platinum and palladium metals, are headed, you can join me on June 24th, where we'll be moderating a panel discussion taking place in New York City. You can register at the link below. In the meantime, I wish all of you a very happy weekend.